In this week's update, markets get a reality check. The Fed sat still, but policy changes are coming. And now a correction starts to be cushioned by rate cuts. My name's Garry Davis, and I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Well, a fascinating week and an abrupt change at the end. So it was certainly a reality check for the US markets and therefore for global markets. We've had a strong bull run, as everybody knows. The markets, as they always do, tend to get ahead of themselves, and that incredibly strong run has now met some reality. Some of it was always there, but the market was just ignoring it. And some of the other reality is new. So let's explore what happened towards the end of the week. First of all, the Fed is going slow on interest rate cuts, which must not please Donald Trump no end. And that is certainly a theme that has got a long way to play out yet, because it really does threaten the independence of federal organisations that should be independent. So I don't know whether Trump has an understanding of what he's doing, but the world's financial system works heavily on confidence, and he's got a shovel out and he's undermining the confidence in the independence of the world's policy setters. So that is very dangerous territory. We also saw some weakening economic data. The PCE, which is the Fed's preferred measure of inflation, came in hotter than expected. Non-farm payrolls were lower, and the previous 2 months were also revised down. So that was not good, and that certainly did precipitate the sell-off on Friday. And then, of course, there was the reinstatement of reciprocal tariffs as well. So the market just doesn't know what it's going to get next, and that's a terrible environment when you've just run very hard and ignored some of those things that were there. We all knew that Trump was unpredictable and that he was likely to do anything, and the market had just ignored it. Can't ignore it anymore, and there's some other factors for the market to worry about as well. So that was a significant reversal, as you will see. And of course, the Amazon result, disappointed to a degree in the short term. I don't think it changes anything much in the long term for Amazon as an investment. And certainly Meta and Microsoft, their results pleased the market. So a bit of a mixed bag when it comes to tech stocks. So let's look at what might happen, and we'll start with the place where we all tend to logically gravitate to, and unless we pull ourselves up, and that is what is logical. Now, the trade deals are largely done. So the focus now, the market has been focused so heavily on trade deals, but the market will now focus much more on the economic data. And the economic data is coming in a bit mixed. Some of it is good, some of it is definitely not good. But if you look at it, the 20% baseline tariffs must raise US inflation. That's the logic. And it's probably the reality, but the question is, has there been enough time for that inflation to manifest itself, or is it not going to be as severe as the logic would dictate? At the moment, the jury's out on the answer to that question. The second logical point is that growth should slow as a consequence. US growth should slow. But at the moment, it hasn't really done that to the extent that logic would dictate. So again, is it too early? Are we trying to make that assumption too early? And it's still coming? Or it's just not going to be as severe as we expected? And the answer to those questions is we don't really know. But all of that logic meets a very euphoric market sentiment that just did an abrupt about face on Friday night. So that's the situation that the US market finds itself in, and therefore the rest of the world. So what could go wrong with that situation? Well, as you know, and I've said it a million times over the years, that if you focus on and act on what logically should happen from here, you'll probably be wrong. You'll almost certainly be wrong, because it never, ever plays out the way that logic would dictate. And that's why you've got to be much more heavily driven by what the charts and the money flows are actually telling you. What is the smart money actually doing with its funds? Not what should it do, but what is it actually doing? Now, if we take a step back and look at earnings season, so far, earnings season has been pretty good. There's an 80% plus beat rate, which is close to as good as you get. So earnings season hasn't let the side down in America at all. And we've got some extraordinary tailwinds of certain industry groups that are pretty easy to identify, and everybody, I think, has a good grasp of which ones they are. But the big picture, longer term for those industry groups is something to really seriously get excited about. Now, the implications of the results, Google, the market was happy with that report. Meta and Microsoft, the market was more than happy with their reports. Amazon disappointed. But I suspect that that will prove to be temporary once people start looking again at just the depth and the extraordinary penetration of the Amazon business and the Amazon results. So personally, I'm not placing a lot of emphasis on these logical outcomes because they so rarely play out the way that you would expect. All right, now in terms of responding to price action, these are just some of the sectors and some of the industry groups that just do look absolutely bulletproof for the long term. AI is real. It's not a bubble. So when you read an article that starts with a heading saying AI is a bubble, toss it in the bin because AI is definitely not a bubble. Some stocks might be a bit expensive, but certainly AI is not. And if you listen to some of the industry insiders, people that really know what they're talking about, the vision and the reality that they paint for the next 5 to 10 years is just something quite extraordinary. It's beyond what anyone is likely to imagine. So AI definitely real. And there is such a broad church of opportunities within AI. I'm not going to go through them now, but there's just enormous opportunities across a whole lot of different service providers. And I think the market is increasingly embracing the stocks beyond just the straight AI technology. There is all the peripheral companies around it. So I think you need to think about, and there's a huge benefit of thinking beyond just the technological leaders in AI to find growth at a reasonable price. And they certainly do exist out there. There are terrific tech stocks or tech-related stocks in America that are growing at 50% plus per annum, and they're trading on P's of around about 10. So there is still enormous value to be had if you know where to look and you dig deeply enough. The next area, of course, is far higher defence spending. That is real. There's no hype about that, and that won't be reset until at least 2029 when Donald Trump disappears. But it may well be sustained at a higher level than where we're at before. Critical minerals is real. There are applications into almost every facet of life, as well as the issue, of course, of national security. So that's very real. And there are so many related industry groups within critical minerals. And the energy transition is real. And probably the best way to play the energy transition, as the gold rush was played a long, long time ago, is the picks and shovels. They don't bear the risk of the miners or the frontline companies, but they are providing services and equipment and expertise to the industry. So there is an enormous amount of really exciting possibilities to focus on. So I wouldn't be too worried about whatever this correction, if that's indeed what it is starting to be, whatever that tends to play out to. Now, in terms of what do you do, there's no single right answer to this because to a degree, everyone is different. Every investor is different. So it depends on your game plan. It depends on your time frame. Are you thinking the next 12 months, the next 5 years, the next 10 years? So you've got to do some of this planning yourself. But there are companies that have got exceptional growth. They've got exceptional fundamentals. And 80% of US earnings season is beating estimates. So there needs to be some degree of corrective activity because the market had just got too frothy. But I really can't see that it's going to be leading to something more significant. However, we always have the danger that when markets have been running hard and have got really enthusiastic, that we get a level of forced deleveraging and a level of rotation, and that does things to stocks that really don't deserve to be sold, but they get sold anyway. So there's always that unknown, and I suspect that will happen again because there is still a lot of leverage in the system. So the answer is to own quality assets. And then, as I've covered a few weeks ago, if a correction is likely to be less than 3 to 6 months, then really why do anything? If you're a long-term investor and you own quality stocks, there really isn't a need for you to do anything. There's always this urge, you feel like you should do something. But unless this is going to morph into something more substantial, and I just cannot see the environment where that's going to happen, then it's best just to do nothing. Maybe a bit of hedging just to make it a bit easier on your psychology, dampen down the volatility, but it's best to do nothing. All right, now, of course, getting all the independent advice that you require, be it financial, legal, or any other advice, is really, really important. Now let's turn to American stocks. The S&P fell 2.35% for the week and the NASDAQ slightly less, but still they are reasonably robust falls, and it all happened on Thursday and Friday. The Russell was down 4.2%, so breadth really collapsed. That's disappointing, I'd have to say. So that was a bit of a nasty. But it does follow an incredible run from Liberation Day in March and April. So a correction now becomes likely, and I think certainly the market action is suggesting that's going to happen. Some of the meme stocks that the market has really been pushing hard of late, I think they're going to get absolutely smoked. And I saw plenty of 10, 15, 20% downward moves on Friday. The US dollar index was at 98.69. The 10-year yield fell. And the VIX index moved up from, I think it was around 13 last week, moved back up to 20. So let's go and look at some charts and see what the market is actually doing. This is the NASDAQ. So you can see we've been trundling along really, really nicely. Thursday gapped higher on the open and then traded down. So there is your change of character. So the character had been positive all through here. Then we get a gap up. So on the open of that session, the sentiment is still positive. By the end of the session, the sentiment has turned decidedly negative. And then on Friday, we get a huge gap down, and then it continues to trade down. So that constitutes a very significant change in character. And so that is highly likely, not guaranteed, but that is highly likely to signal the end of this run for the time being. And there'll be a correction. Now, that correction could last for weeks, could last for months. But I just cannot see that it's going to be anything that long-term investors should be concerned about. Now, if we look at the S&P on a daily chart, you can see exactly the same pattern occurred with the S&P. So if we look at some of the more individual money flows, this is the NASDAQ versus the S&P, not much change there. They're just sort of going line ball with each other. Consumer discretionary got impacted a little bit because Amazon is in the consumer discretionary sector of the market, so that did impact that one. And the S&P versus gold, we saw gold turn back up again. It had been under pressure with the US dollar rising. Gold turned back up again and the S&P turned down, so that had an impact on that ratio. SMH, semiconductor ETF, a really important indicator. Doesn't look all that dramatic. You can see that is nothing like as dramatic as that is. So that is a point of encouragement for the market. Now, if we look at sector by sector, technology got hit in fact, everything really got hit very hard. You've got to go all the way down to consumer staples and also healthcare. So staples and healthcare turned up at the end of the week on a relative basis, but everything else got hit pretty hard, and that was pretty sharp declines. And I think that is going to be what is with us that's going to be the sentiment for the next few weeks. So get used to it. In Australia, we saw a turn down in the IT sector, information technology sector. That will no doubt gain quite a bit of momentum on Monday. So expect to see pretty much all of these turn down in Australia on the Monday. All right, now let's just have a quick look at the currencies. So first of all, the US dollar had been running very strongly. We'd moved up from 97 to 100, and then it all turned sharply lower. That was, of course, on the expectation that the Fed would not be cutting rates, that rates would be held higher for longer. And that's still the case, but the US dollar was sold off anyway. The Australian dollar, pretty disappointing. It really didn't rebound with the US dollar going down strongly on Friday. The Australian dollar suffered as well. So Aussie Stocks, our dollar finished at just under 64 cents. And there really is a range of outcomes that are possible to the year end. It depends on China. It depends on the US dollar. It depends on quite a number of things. So the range of the Aussie dollar, probably somewhere between 63 and somewhere like 67, is likely to be maintained towards the end of the year. The ASX 200 fell just a tiny, tiny bit for the week, but that, of course, will change on Monday. But look, there's no need to fret. This is really just more of an awareness thing, because as I said before, I just can't see that this is going to develop into something really significant that lasts more than 6 months at the index level. And there are just so many amazing opportunities in America and Australia. See those opportunities for what they are, and this should be a good period. Might be a bit uncomfortable for a few weeks, but there is a very good opportunity coming. Turning now to precious metals, gold was up $25 to $33.62, and in Australian dollars, with our dollar moving down, we almost got back to 5,200 in Aussie dollars. And silver also poked its head back above 37. With gold stocks, really quite interesting. There's a very diverse set of all-in sustaining cost numbers for FY25, and for me, that's been one of the metrics that I've been following very closely, because there is quite a range. And it spans from, in Aussie dollars, from 1,550 to comfortably above $3,000 an ounce. So this theme of the all-in sustaining costs having risen dramatically, now that does get, of course, impacted by how much capital expenditure is required. But two things: there is a very wide range, and secondly, cost pressures are really affecting everybody. Let's go and look at some charts. Let's have a quick look at the Australian index first. So there's our index. We popped up higher, particularly on Wednesday, but then gave it all back on Friday, and that will almost certainly gain further momentum to the downside at the start of the new week. Looking at precious metals, there's silver. We'd been in decline. Precious metals had been under pressure, but certainly turned around on Friday. And that is likely to continue given this new environment. There will be a fear premium come back into the precious metals price. That's the gold price in US dollars on a daily chart. In Aussie dollars, pretty much flatlining it. We haven't really moved since about April, so no real change in the Aussie dollars. And Bitcoin also being sold down, which is interesting, going the opposite direction. It's been moving a lot in tandem with precious metals. But we've got this very strong support level at 112,000. We closed at 113,000 and a bit. So this is a key level for Bitcoin. So turning now to other commodities, or first of all, Bitcoin. So there are Bitcoin falling either with or without the US dollar impact. So it's a bit hard to anticipate where Bitcoin is going to go in the very short term. But certainly long term, as I've been noting pretty much all this year, the institutional acceptance of cryptocurrency is the thing that's a real standout for me for this year. All right, other commodities, copper was at $4.42. So copper got absolutely poleaxed. You might recall last week, copper was trading at $5.70. So absolute smashing. And it was just all of the toing and froing with shenanigans. I really don't know how markets operate at all practically with all of these changes backwards and forwards, it's quite extraordinary. So the premium that was in the COMEX copper price disappeared. There was an 18% drop on Friday on the shift in policy. So that was really quite dramatic. And now there is it would appear instead of a 200% tax, there is now going to be a 50% tariff, but not on all copper products, just on semi-finished products. The other one may get postponed back to somewhere like 2027. But look, who knows? Because Trump just changes his mind every other day. So it's really impossible to know what the position is. All we can do is just think longer term about what are the fundamental drivers, and they're very attractive, certainly for copper. This was the largest one-day drop in 37 years. So that's not good for markets when that sort of thing happens. It's just crazy. In Q3, the front-loaded imports that were happening are now being unwound. So that's what's really driving this. There are some structural supply issues, plus we've got underinvestment still. So that remains a long-term driver for the copper price, because there just is not enough, not even remotely enough investment going on to find and build the major mines that are going to be required, not only to cover depletion from existing mines, but to meet the much higher level of demand. It's just not going to happen. So from a long-term perspective, the copper price really does look like a good bet. West Texas Intermediate crude, 67.2. The risk premium is back. We've got tariffs. I think that should be 14%. I've got a sticky 4 key on my keyboard. But there are tariffs on oil from Canada and India, sanctions on Iran, and some things going the other way on Brazil. So as always, it's a very confusing picture for crude oil. There's the copper chart. You can see just the dramatic collapse as that premium that had been front-loaded into there got very, very quickly unwound. So wrapping it all up, what we do is to empower investors. We're not a service that just provides recommendations on what to buy. We are really about giving investors the information and the guidance and the education to make much better decisions themselves. So what you've got to start with to make that repeatable is a hierarchy of thought to set your plan. It's very simple, it's very straightforward, it's very repeatable, but a lot of people just, for whatever reason, seem to resist doing it. But it really is quite a simple, straightforward process. And it really is about deciding what you want your portfolio to ideally look like to deliver you what you want. And it's no more complicated than that. And if you don't know what the options are, that's fine. But if you've got that hierarchy of thought about how to think about it, what are the key questions? And there's really only 3 or 4 key questions you need to ask yourself. But get that sense of what you want your portfolio to look like. And then identify the sectors, the specific targets within each of those sectors. And there's more than enough sectors for any investor now that look like they've got almost unassailable tailwinds. And then, of course, we get down to the entries and the exits. Ideally, we're buying into these stocks on a bit of a dip. And I think the next little period is going to provide some wonderful opportunities to do that. And then the biggest danger, of course, is that you just get consumed by life and you lose track of what you're doing. So you need to continually have your perspective refreshed to stay on track. But if you can do all of those things, you're going to get far, far better results. And this type of empowerment is far better than the prescribed personal advice. You know, the advice which is more about box ticking than actually doing something sensibly, because it teaches you how to think on the job yourself. So you don't need to rely on other people. There are some very dire forecasts out there. We could jump at shadows because of them, but they're always out there. They've been there for decades and they always will be. Or we can just simply respond to what is according to the plan that we've developed and just do that. And it works very nicely. Now, portfolio analyst last week, we covered the market setup, in detail, and there'll be certainly more of that this week for obvious reasons. And looking at what actions are prudent to take for you as an investor and ones that are productive, because there are many actions that we could take that just aren't helpful. They aren't productive. So that's it for this week. There is more information on the website, and there's my email address, and I'll be back with you next Sunday. Cheers.